just before we go. So you see the moving of the screen.
Yes.
Okay, perfect. So so thank you for joining me today. I appreciate it. My presentation, I guess I might as well move on to the next one. But before I do, the title, with a recession likely, how will lumber markets fare? Actually, so our current forecast does call for a recession, but interestingly enough, despite the fact that, or maybe because of the fact that unemployment was lower than people thought and wages continue to rise, so that's leading a lot of folks to think that the Fed might, and the market and the stock market in particular, you've seen this with bond yields going up and with stocks coming down. It's indicating that the market money is pointing towards the fact that the Fed's going to continue to raise interest rates, which a lot of folks might think of as meaning that the probability of a hard landing has increased. But we're actually taking a bit of a different tack on this and saying that it's possible that the probability of a soft landing is actually increasing. And what do I mean by that? Well, the Fed's raising interest rates, and inflation is coming off, and yet employment is not really coming off that much. Well, it's not coming off, and unemployment's really not moving up much. So, so I guess I was hoping after COVID and the crazy 2 years that followed, we would be at a point in the economy where I wouldn't have to say that looking into the future is extremely difficult. It's always difficult. Obviously the COVID years where things were extremely volatile. It was extremely difficult to predict what was going to happen. We were thinking that things might become a little bit easier as we moved out of COVID and the economy returned to more normal. But of course, even with this a little bit more normalcy in our economy, we're having a situation where the Fed's raising interest rates, and yet the employment markets remain strong and income growth remains pretty strong. So maybe we actually will be able to pull off a bit of a soft landing. So to the extent that that doesn't happen, I am presenting you a forecast from that was completed in February, but really started in January. So what's changed since this forecast, since we started this forecast, in that it's looking like if we do slip into a recession, it's likely to be further out than we're calling for, and what I'm going to show you here. In other words, it's likely to be really more the end of 23 or beginning of 24, and not in the middle to latter half of 23, which is what I'm going to present. So I'm happy to to address this in questions if you folks want to hear that. But I guess part of the curse of doing 15 forecasts a year is I have to do 15 forecasts a year, so I'm wrong an awful lot. But on the positive side, we can change our forecasts pretty quickly as the markets change. So just a real quick overview. I do want to talk about the overall economic outlook, and then talk about end-use markets specific to use of our products, implications for demand, and then talk about how this is going to affect costs and pricing. Now, do touch a little bit on trade, and then also on pulpwood and biomass markets as well at the end. So to begin with, I talked about this a little bit. We do expect a mild recession. You can see in this forecast that it's in Q2 and Q3 of this year. As I mentioned already, if this is going to happen, it's more likely to be pushed out. Hopefully you can see my cursor, but it's more likely to be pushed out into Q4 or Q1 next year, and that actually the beginning of this year probably will remain positive in terms of GDP growth. Having said that, our main end-use market, right, is housing, and housing markets historically housing markets have led the economy, right? They tend to be leading indicators and not lagging indicators, and that's because rising interest rates affect mortgage rates. So rising interest rates are the tool that the Fed has to control the economy. They raise interest rates when they want to slow it. Rising interest rates affect mortgage rates immediately, which affects housing markets immediately. So that's why we're a leading indicator. So even if we do have a recession that's later on in this year, I think that you're going to see that the housing market, the effect on the housing market is almost certainly going to be in the first 6 to 9 months of this year in any case, which is pretty much what our forecast calls for right now. So why do we think there's going to be a recession? I'll go through some of these indicators quickly. Happy to address them in questions that you have, if you guys have questions. And then I do have my contact information at the end. If you want a copy of the presentation, feel free to reach out to me. So in any case, so what are some of the reasons why we think that the economy is going to slip into a recession? Well, for one thing, the leading indicators have been declining. So it did stabilize in January, but they declined for 12 straight months throughout 2022. So what is a leading indicator? Well, it's what are the leading indicators series that we show here? It's just a mix of a number of different indicators, putting them all together so you don't have to look at them individually, to show us a sign that the U.S. economy is likely to be slowing down here going forward. And you can see that anytime these leading indicators dip down, significantly below 100, that's really a period around those gray bars, and those gray bars are where we've had recessions. So when this leading indicators dip, we do have a tendency to slip into a recession. Probably more importantly, or certainly at least as importantly, is that the yield curve has inverted. So this is just simply the 10-year Treasury minus the 3-month Treasury bill. The reason why this is important is because banks borrow money short term and they lend money longer term. So when this yield curve inverts, when it goes negative, that means short-term interest rates are above long-term interest rates. So banks' borrowing costs are above their lending costs, or their lending revenue. So that is, or it's an indicator of a squeeze, because it's not actually above that, but banks have to raise their rates in order to prevent that from happening. That makes the cost of capital more expensive. Banks get more discerning with their lending, and so we see that lack of capital start to slow the overall economy. And you can look at this historically going back to 1970, and you can see that prior to pretty much every recession, the yield curve is inverted. So the fact that it is inverted again is a pretty ominous sign. Having said that, we do think any sort of recession that we get is going to be mild, and there's a number of reasons for that. One is if we look at all of the indicators that the National Bureau of Economic Research looks at when they decide whether or not they're going to when they determine whether or not we've actually had a recession, only 3 of the 6 of them are trending down. So 3 of the 6 of them are still fairly strong. So that's an indicator that that we might not slip into a recession, and even if we do, it's likely to be mild. And I just throw this up here. This is our current forecast on an annual basis. It's a really interesting thing to me, and something that I thought about having been in this industry for nearly 30 years. If you think about, for some folks who say you've been in this industry a long time, and you've been in this industry for 20 years, right? That's a pretty long time to be in this industry. But if you've been working for 20 years, the only 2 recessions that you've lived through are the Great Recession, which was the worst recession since the Great Depression, and the COVID-19 recession, which was actually worse than the worst recession since the Great Depression. So, for folks who have been in this industry for 20 years or fewer, you've only lived through 2 of the worst recessions in, essentially almost a century. So I think for a lot of folks, they kind of look, if you're looking back at your career, you're thinking, oh, recession, this is terrible, like things are going to be really, really bad. Last time we had a recession, housing starts dropped down into 500 to 600,000 units. We would argue that compared to that, this is going to be a very mild recession. So in something more akin to the recession that we had back in 2001, where even though we had a recession back here, for the year, GDP actually still grew 1%. So we still had okay growth in GDP. So so just wanted to put this into a little bit of perspective that, these big downturns that we've seen and these recessions that a lot of folks have lived through over the past 2 decades, those really are the aberration. And a much more normal recession is something that's, has housing starts dropping to somewhere between 1 and 1.2 million units, and not down to 500 to 600,000 units. So just kind of keep that in mind as you're looking forward over the course of the next year. So why do we think this recession is going to be mild? Well, for one thing, the reason why the Fed's raising interest rates is because inflation is extremely high. And so they're trying to quench that inflation. So the bad news is that inflation had gotten very high, and so the Fed had to raise interest rates. But the good news is that inflation is coming off. So we're seeing inflation come off fairly sharply, and we think that's going to continue. We think inflation is going to continue to come off sharply. So why is that? Well, typically, when you have high inflation, well, always you have an imbalance between demand and supply. So demand exceeds supply. But normally that's because demand is very, very strong and supply just can't keep up with demand. But this time around has been a little bit different. Demand has been strong. I mean, government's pumped trillions of dollars into the economy, which has certainly boosted demand. But on top of that strong demand, we actually had very severe supply side constraints. And those supply side, I think we all know what those supply side constraints are, what they were caused by. They were caused by COVID. The disruptions to manufacturing. So we import a lot of goods, obviously from overseas, and China in particular. The disruptions to manufacturing in China with the just total lockdown of their economy. On top of that is even going forward as China starts to open back up again. Well, I shouldn't say going forward, but even to the extent that there were other regions that were producing goods, the ships and the containers were all locked up in various ports because they weren't being moved around because they couldn't get back to China. So we had transportation disruptions, and we had labor force disruptions which further exacerbated those supply chain disruptions, and those occurred at the manufacturing facilities. You couldn't, if someone got sick, they would have to isolate for 10 days, or if they got exposed, they would have to quarantine for 14 days. So the workforce went through some pretty major disruptions. On top of that, you had folks retiring early because the risk of, if you were working, you were close to the end of your career, you're in your late 50s or early 60s. Those were the folks who were at most risk from COVID. And on top of that, they were close to retirement, and the stock market did really, really well, so they had funds to retire. So we saw a lot of the more experienced and the more productive folks retiring, being replaced with younger folks who are not nearly as productive. So there's just a lot less. Manufacturing was slower. And then we just keep on going through the entire supply chain. Then you get to the trucking and to the trains, and we had disruptions with the trucking and the trains because you didn't have the drivers to move the products to the market. So across the board, those supply chain disruptions were a major component to driving prices up as high as they went. So it wasn't just demand side this time, it was also supply side. So what's happening on the demand side? The Fed has raised interest rates, which should start to put some downward pressure on demand. That's on the demand side. And then on the supply side, what we're seeing is that those supply chain disruptions that occurred during COVID, these really significant supply chain disruptions that occurred initially, and then the lagging effect of supply chain disruptions that occurred because of workforce retirements, because of folks having to stay out, because of quarantining and isolation issues. Those are really behind us, and the supply chain is now moving much more quickly. And if we look at actually on the manufacturing side, we're going back, and the delivery times are pretty much at their lowest levels, their shortest levels, except at any point except for during the 91 recession and the Great Recession. So delivery times are certainly much better today than they were during that peak of supply chain disruptions, which was helping to drive prices up. In addition, I had mentioned earlier that we import a lot of goods, and so one of the things, so the U.S. dollar has strengthened dramatically, and it has come off from its peaks, but it's still significantly stronger than its longer-term average, and that means that these goods that we're importing are cheaper. So we have fewer supply chain disruptions, meaning the products can get to the market, so there's a greater supply, meeting with the decreased demand because of the rising interest rates. On top of that, the cost of these manufactured goods are cheaper. So these are all putting downward pressure on price of goods, which should help to lower inflation. I'll go through these next two slides pretty quickly, but one factor that certainly affects inflation, if you're looking at the broad basket, CPI basket, is energy prices. Oil prices feed through into gas prices, which actually this next slide is just gas prices. You can see it's a very similar story, but the importance of oil as opposed to just gas is that that feeds through into heating, that feeds through into manufacturing, it feeds through into diesel and transportation. So the fact that oil prices and gasoline prices have come off is certainly good news in terms of lowering the potential for inflation. In addition, M2, money supply. So that's the amount of cash that's floating around in the economy. That is starting to come off, and actually we're seeing fairly sharp declines in money supply. So with less money out there floating around, that's less money to buy goods, and so that helps to lead to lower inflation. So all of these things make us think from an inflation perspective, we do see inflation continuing to trend down, which means that we think the Fed is near the end of its tightening regime. So we're not suggesting that the Fed's going to start to lower interest rates anytime in the near future, but we do think that certainly it's likely that they're going to stop raising interest rates either in their June or July meeting. So we'll probably get another increase in March, likely to get an increase in May, might get an increase in June. But then by July, we think the probability of them holding firm is pretty high. And that becomes important, and I'll get into this a little bit later when I show the interest rates, but that becomes important because your mortgage rates are set based off of your long-term bond yields. And there's a spread between those two. And when your bond yields are rising, that spread increases. And when your bond yields stabilize or decline, that spread starts to decrease. So not only do you have a stabilization in interest rates, but also the spread between the mortgage rates and the bond yields actually starts to come down too. And I'll show you that in a few slides. But in any case, inflation coming off. So that's the Fed is likely to stabilize, which should mean that as that happens, we're at least no longer seeing that tightening pressure slowing the economy. Other reasons to be optimistic and think that this recession is going to be mild is that the labor market still remains very tight. This graph right here shows the number of job openings per unemployed person. So a reading of roughly 2, which is about what we're at, means that there's 2 job openings for every unemployed person out there. So even if we employed every single unemployed person, we would only take care of half of the job openings that are out there. So there'd still be about 50% of the job openings that we have today would still be vacant. So we have a major shortage of labor. And this is translating into higher wages. So we've seen the wage growth accelerate, and we've seen wages increase. So that is both a good thing and a bad thing. So it's a bad thing from the inflation perspective in that higher wages obviously feed through into higher costs, which feed through into higher prices. But it's a good thing from an overall economic perspective in terms of consumers' ability to purchase goods, because as consumers can purchase more goods and services, that tends to lead to greater overall economic activity. So the higher wages is good for the overall economy. And in particular, the way the wages are going up across income brackets is actually quite good. So over really for a very, very long time, it's been the top quartile, so the 4th quartile, the highest wage earners who are seeing most of the growth in their wages. But with this current run up in wages, we're actually seeing more of that growth accrue to the 1st quartile, so the lowest quartile of wage earners. So that's important because if you are someone who's making $100,000 a year and you get a $10,000 raise, you're probably going to save a big portion of that because you don't need to use that $10,000 to meet your daily living needs. But if you're making $10,000 a year and you get a $1,000 increase, which is the same 10% increase, you're likely to spend all of that because you need to spend that money to meet your daily, your living requirements. So generally, so the faster wage growth in the lower quartiles leads to more consumption, which is more economic activity. Some more reasons to be optimistic is that the U.S. household balance sheets are in great shape. So what this graph shows is this is just financial obligations as a percent of your disposable income. So this is just simply what percent of your income goes to meeting your current financial obligations. And aside from these two big dips, which really were simply the result of government transfer payments during COVID, a combination of government transfer payments during COVID and then people not taking on additional debt, so not spending money because they were concerned about the economy. Aside from these two dips, our financial obligations are really at their lowest level that they've been at, going all the way back 40 years, 40 plus years. So our balance sheets are in great shape. So our households can really weather a recession much better than they were able to, say, in 2008-9, when our financial obligations are actually very high relative to any time in history. You know, this is probably just another, well, this isn't actually another way of looking at that, but it's another reason to be optimistic, and that's that, you know, so the stimulus money that went out, combined with the lack of spending because people were, you know, locked into their homes, led to a massive amount of excess savings. So at this point, the Fed estimates that that current excess savings that still exists throughout the economy, throughout households, is a little under $2 trillion. So that's a lot of money to help weather the coming recession. What does that mean? Well, you know, if you have if you lose your job, or if you might be, first off, you might be a little bit less afraid of losing your job. You might be a little bit more willing to move jobs, especially with the tight labor market. That's going to increase wages. If you lose your job, instead of cutting back your spending dramatically, you'll have some savings to fall back on. So whatever recession that we have likely won't be as steep because of this excess savings. So mortgage rates. This is another interesting graph, and they have gone up since I put this graph together, but they have gone back up again. But this is your mortgage rates versus your bond yield, and so you can see that there's a real high correlation between the two. The more, it's actually not just correlation but causation. Mortgage rates are driven by those 10-year bond yields. That's the 30-year fixed rate mortgage. And you can see that as bond yields started to go up, mortgage rates started to go up. The other piece, though, is that not just the rates went up, but the spread went up. And the reason for that is that, so if you were a lender and you're looking at rates moving up, and you're looking at moving up over the next 6 months, 8 months, a year, you know that if you're going to lock somebody into a rate, they might not close on that for 3 months or 2 months. You know that in 2 months from now, it's highly likely that the 10-year treasury yield is going to be higher than it is when you locked in that rate. So you're going to want a higher premium on your mortgage than you would in a falling interest rate or even a stable interest rate environment. So the gist of all of this is that the gap rose. Historically, the gap between the 30-year mortgage and the 10-year treasury yield is about 1.7, 1.8%. That had risen up over 3%. And so that increase in that spread as the rates go up, we could actually start to see mortgage rates come down faster than treasury yields once the Fed stops raising interest rates, because there's no longer that concern that going forward, you have to make up for increasing rates going forward. So we do think that looking out over the course of this year, we should start to see mortgage rates declining some as we get into the second half of this year, but even into the second quarter. But having said that, I guess I should go back to point out that mortgage rates are significantly higher than they were a year ago. In addition, home prices are much higher than they were a year ago. So they're 25% above their 2006 peak. They are about 40% plus above their longer term trend. So home prices are very high. Mortgage rates have gone up. Home prices are high. And that translates into it becoming significantly more expensive to buy a home. So, so this just shows your principal and interest payment on a median price home on 80% of it, assuming you put 20% down, which is probably a pretty big assumption right now. But that assumes it'd be the same. The percentage change would still be the same, which is essentially from the beginning of last year to today. Your principal and interest payment on a median price home is above more than 50% higher than it was a little over a year ago. So it's just become a lot more expensive to buy a home. So in part, this is why. So becoming a lot more expensive to buy a home, means there's fewer people out there willing to buy homes. So so builder confidence has fallen. Home sales have also fallen. So these are just all a bunch of statistics which indicate that if we're looking specifically at our markets, and the main end-use markets being residential construction, we do expect to see these come off this year. So the higher interest rates, the higher home prices, which has really taken a whack at affordability, the declining builder confidence, the declining home sales, all those indicate that housing starts are likely to fall from their a little under 1.6 million units last year to a little under 1.3 million units this year. I think we're generally fairly optimistic relative to people we talk to in the industry. Although if we look at sort of the housing starts forecasts that feed into consensus, we're probably pretty close to consensus. We might actually be a little bit below consensus. Well, we were a little bit below consensus at our 1.3. But we think relative to people that we're talking to in the industry, we're at 1.3 for this year, I think most people that we talk to think that we're overly optimistic. But given given a few things that I'm about to talk about, plus the things that I talked about already in terms of the strong employment and the strong growth in incomes, that's certainly a positive, and part of the reason why we don't expect to see housing drop too dramatically. But another portion just simply has to do with the underlying fundamentals of the housing market. And I know I've talked about this a lot in the past, so I guess I'll apologize for those who have seen me do this presentation before. But what are those fundamentals? These are really important to understand why we're unlikely to see a recession similar to the Great Recession or even COVID in terms of housing markets. So those strong fundamentals are, one, underlying demand. And what's underlying demand? The two main components of underlying demand are household formations and removal or replacement demand. And removal or replacement demand is pretty easy. It's fires, it's tornadoes, it's earthquakes, it's people knocking down homes to build new ones, older homes to build newer ones. So that's a decent component of that. That tends to be around 350 to 400,000 units per year. But the biggest component of underlying demand is household formations, and that's made up of a combination of the adult population growth and age class distribution. So if we look at that, and just for now we'll take for granted that underlying demand is accurate, which historically it is. Forecast is obviously, well, I guess this is all historical. So, but beyond 2020, it's still a forecast because this data comes out with a pretty big lag. But what you see in that green line of underlying demand, and then the red line, which is actual housing starts, is that actual starts tend to fluctuate around underlying demand. So some years we're above, some years we're below. When we go above for a while, we have what's called spent up demand. So we actually borrow some demand from the future. And then as we get into that future, we're borrowing, I don't know if you can see my cursor, but we're borrowing demand from the future back here in the early 70s. And then as we get into that future and affordability declines, we have a sharp drop in housing starts, in which we're kind of, we're suffering the hangover from the increased demand and that spent up demand. But then we start to pent up demand. We start to get some pent up demand. We eventually get to equilibrium, where demand and where actual production and underlying demand are in line. And then you get a period of which you have some pent up demand. So some folks who would like to buy homes aren't able to, or they're not doing it. And so these people want to separate out and form homes, but the production's not there. So then we get a period again of over demand. So we go above and below and above and below, and it all equals out until about the mid 1990s, at which point we have a long stretch of overbuilding. So a large amount of spent up demand. And that was part of what caused the crash in the housing markets. But then by 2010, we had made up for all of this overbuild right here by the time we got to 2010. So all of this period from 2010 up until 2020 was a very, very long period of underbuild, where we have a tremendous amount of pent up demand. So this is just simply, folks who want to separate out and form a household who are not able to. So this is parents living with their adult children. It's adults living with their parents, so young folks, say in their early 20s, living with their parents longer than they would have historically. This is This is younger folks taking on more roommates, having 5 roommates instead of 2 perhaps. So this is all that pent up demand that's built. And even if we look at this over the 21-22 period where we go above, we're hardly above for very long at all. So the gist of all of this is we still have somewhere around 2.5 to 3 million units of pent up demand that's out there. So even if we were going to meet this demand over the course of the next decade, that's still 200,000 to 300,000 units, 2.5 to 300,000 units per year, in addition to the underlying demand that we need to build. So we got a lot of makeup building to do. So that's part of the reason why we don't expect to see housing starts drop to a typical recession low. Another reason is that there are really, really strong demographic tailwinds. So what this graph shows is the age class distribution of our society, of our adults. Well, actually it's everyone because it goes back, but the key component here is the yellow area. So this is your late 20, early 30-something-year-olds. Those are your prime home buying years. And you can see that that age bracket has a peak. So those are our largest age groups are in their late 20s and early 30s right now. Those are your prime home buying years. So that's really strong demographic tailwinds. So not only do we have a lot of pent up demand, but we also have strong demographic demand because of the age of our population. I just want to point out for some folks who say you've been in this industry a long time, but it's only 20 years. So your last real recession that you experienced was the Great Recession, which occurred here in 2008. You may be saying, well, you seem really optimistic, Paul. Just to point out 2 things. One, leading into 2008, let's see if I can find my cursor. Leading into the 2008 recession, oh, there it is. We had a tremendous amount of spent up demand. Leading into this recession, we have a tremendous amount of pent up demand. Leading into the last recession, which is this green line, which is 2008, we actually had a dearth of folks in their prime home buying years. Leading into this recession, we have a peak of folks going into their prime home buying years. So these are all reasons why this current recession is likely to be a lot more mild, and the housing downturn is likely to be a lot more mild than historical. And I know I've already put this up here, but I just wanted to throw this up here as well. Again, just comparing this recession to the last recession, the Great Recession, we had households were in a lot worse financial shape than they are now. It's a few other factors. Well, one other factor is that existing home inventories are extremely low right now. So if they are going to meet demand for, if we do have a lot of pent up demand, if we do have a lot of, and we do, and to the extent that we have strong demographic tailwinds, this is not going to be met by existing inventory because there's just not a lot of existing inventory out there. So it really is going to need to be met by new construction. So all of these are reasons to think that our construction markets likely aren't going to be as weak in this downturn as they would in a more historic one. You want to turn our attention right now quickly to improvements, so additions, alterations, improvements, that sort of thing, because that's another main end-use market for lumber. So this is residential improvement expenditures. It's from the C30 report. You can see that we do have a sharp decline, but I just want to point out that this data is quite volatile, and it's also subject to large revisions. So while we have a sharp decline, we also had a very sharp increase, and we don't think this increase actually happened. We think that there certainly didn't show up in the lumber and panel markets. And we think that there's likely a measurement error going on with Census, who collects this data, and we think that this data is ultimately going to be revised down. So I just don't look at this 20-something% decline and think, oh, this market's going to be terrible. We're really looking for something closer to a 5 to 8% decline in R&R activity once this data gets revised. In addition, and that, by the way, I don't want to get into the technicalities of our model, but that gets factored in through usage rates. So our actual consumption decline is only about 5%. And happy to address that in questions or offline. But in any case, the R&R, or the improvements indicator that we're looking at that to drop and basically be right around trend level. So which is really pretty high, because typically when you have a recession, it drops below trend, but we're not really looking for it to drop much below trend. We think it's going to be strong for a couple of reasons. One, our housing stock is very old. So even if we take into account all the improvements and additions and alterations that have taken place, if we look at our median stock today, with improvements taken into account, they're still about 22% smaller than a new home that's getting built today. So for folks who have bought an existing home over the past 3 to 5 years, their homes, the median home is quite a bit smaller than a new home that's getting built. And if they, if they have the equity built up in their home, it's likely that they're going to want to fix it up, make it a little bit bigger, especially given the effects of COVID, the increase of work from home. We have significantly larger percentage of our population is now working from home, and so you're going to want to see some expansion there in the sizes. On top of that, in the past, when people wanted a bigger home, they would oftentimes buy a new home. But the new home inventory the existing inventory doesn't exist, so it's going to be tough to move up, and new homes aren't getting built, to meet demand that's out there currently, let alone people with existing homes wanting to sell them and add and buy a new home. So without that increase in supply, we're going to see people fixing up instead of moving up. In order to do that, obviously they have to have access to cash, and that's where the home equity comes in. And home equity is at record highs. And this is actually quite important, because if you're thinking about moving up, you need to get rid of your 3.25%, 2.5% mortgage that you locked in a couple of years ago, and you're going to be taking on a 6 or a 7% mortgage. Whereas if you're looking to fix up, if you're looking to add on to your current home, you actually can tap into HELOCs, that home equity line of credit, where you don't need to, instead of having to refinance your entire mortgage, you can just take a portion of the equity out of your home. So you're paying a higher rate, but it's on a much smaller amount of money. On top of that, that rate is variable. So if you expect rates to come down, that HELOC loan will actually come off when rates come off, and you won't have to refinance either. So for all these reasons, we do think people are going to be fixing up their homes, and those R&R markets should remain pretty strong. So let's put it all together and bring this back to our markets. This just shows you consumption. You can see that we're looking for, in 2023, we're looking for about a 7% decline in North American consumption. That translates into about 4 billion board feet. So I know I've kind of bounced back and forth a little bit. We're going to have a recession. Recession's not going to be too steep. We're going to have, housing markets are going to come off. They're not going to come off that much, kind of going back and forth. The bottom line is that we do expect a downturn. We do expect consumption to fall. We don't expect that decline to be very sharp relative to historical declines. And that can be seen in this graph. And then we do expect a pretty rapid bounce back in 2024. That's the current forecast. We might see this be, have more of a slower rebound in 2024 if the recession is pushed out some. Might see a little bit stronger 23, a little bit weaker 24. But then if we were to go back to 25, if I had 25 up here, it'd still be a pretty fast, we'd still see a pretty quick rebound back to the 2020 to 2022 levels. And that's because of strong R&R demand, because our homes are small and they need to be fixed up. It's because of strong pent-up demand for housing. It's because of strong demographic tailwind. So all of these factors should lead to a pretty quick, robust rebound. In terms of pricing, what are we expecting? This is your Eastern SPF delivered Boston 2x4 price. So obviously prices have come off sharply. We do expect them to remain low relative to where they've been. So to basically for this year, we're looking for prices to sort of bounce around these sort of 400 to 600 level. So significantly lower than where they were during COVID, but actually quite a bit higher than where we have averaged historically. So, so the next few slides I'm going to go through are talking about why we see prices being weak, and then also why we see them being strong relative to history. So to begin with, weakness, I mean, part of it, before I get there, part of it, decline in consumption. So you're going to have a decline in consumption is going to lead to, weaker operating rates, which should put downward pressure on prices. In addition, inventories. So what this graph shows the month supply of inventory at the dealer level, and you can see those really low inventories back in 2022. We had high, especially in the beginning of the year, we had still high prices. But then as we got into the second half of the year, those inventories started moving up and prices were coming off pretty dramatically. And as we get into 23, we continue to have inventories moving up. So higher inventories mean that dealers have less urgency to buy wood. So these are reasons why we think that prices are probably going to remain under pressure in the near term and throughout this year. Having said that, there really isn't all that much room to go down from where we're at right now. So this graph shows costs. These are your variable costs of production. So those are your cash costs in the bars. And then the yellow area shows the duty if you're producing in Canada and shipping down into the US. The dashed line shows current prices. That solid line going across the middle. Oh, before I get to the solid line, the green dot shows your ratio, your average sales price to cash cost ratio. So if that average sales price to cash cost ratio is below 1, then for every 1,000 board feet of lumber you're producing, you're losing money on a variable cost basis. So it's costing you money to produce that lumber and not on a fully loaded cost basis. And then I put that solid black line in there at 1, so you can see that every single region is losing money on a cash cost basis, except for the US Inland West, which is break even. Actually, they are losing money, but barely any. And the South, which it just happens to be currently, well, the South is obviously a low cost region. So, and they're close to end use markets. So they tend to have a higher FOB mill price because they have shorter transportation routes, lower transportation costs. So generally they are going to be the most profitable region. But in particular right now, they're quite profitable as well because their prices are moving up. But if we're just looking at this past week, their prices are moving up, whereas other regions, they've already started to move down. And the southern prices will start to move down with other regions as well as we see substitution because their prices are too high. So so these costs, the fact that prices are below cost means that we have gotten a significant amount of curtailment. So these are actual closures of shift removals. And these are curtailments that occur. So if we're looking at these combined, there's about 1.5 billion board feet of actual closure. So that's actually taken out of the market. And then there's about 600 million board feet of curtailments for a total of 2.1 billion board feet of lumber taken out of the market to date. So this is announced curtailments and closures. So this doesn't count unannounced curtailments. It doesn't count mills running a little bit more slowly because the demand's simply not there and their mill inventories are going up. So this is 2 billion board feet that's been taken out of the market already this year. And that compares to the 4 billion board feet of the lower consumption, but that's over the course of the whole year. So certainly there'll be more curtailments as the year goes on to keep production in line with demand. So we do expect that given current cost levels, that our current pricing is probably, prices do fall below costs and they stay there for a while. We get curtailments, then prices bounce back up above. But the days of $100 to $150 price declines are over. Now at this point on a weekly basis, you may see $20, $25 down, slipping down to $5, $10 price declines because there's just not that much more room to go down with your prices. Mills will start closing, as we've seen. Another piece as to why, so why do we think that prices will be higher? So the next few sets of slides, I'm going to get into why we think prices will be higher relative to history, looking forward over the next couple of years. For one thing, one of the things people point out is, what about all that new capacity that's coming online? Well, this is just new capacity where mills are actual new mills that are going to open up. This is existing investments in existing facilities. Here's more existing facilities. I had to break this into 2 slides. So if we add these all together, it's 2.6 billion board feet of new capacity, and it's 1.3 billion board feet of investment at existing capacity. So that's roughly 4 billion board feet of new capacity slated to come online 22, 23, 24. So why aren't we more concerned with this 4 billion board foot decline in consumption and 4 billion board foot increase in capacity? And the answer is that that's nameplate capacity. It's actually turning out that a couple of things. One, while we do see a lot of investment in new capacity, we're seeing capacity curtailments or closures in other regions. The South in particular is seeing a lot of investment in new capacity. Other regions are seeing closures. On top of that, it's proving to be very difficult to get these mills built and then up and running to their nameplate capacity. And so while we did see about 5 billion board feet of capacity expansions between 2019 and 2021, we've barely seen any increase in output in between 2020 and 2022. In fact, we've actually seen a decline in output. So we've seen output go down, despite that 5 billion board feet of increased capacity. We've seen output go down 1.2 billion board feet or 1.3 billion board feet. So how come we haven't seen a more rapid uptake in the production? Well, it starts with the machinery manufacturers. So there's machinery manufacturers are having trouble getting the labor to build the equipment. They're having trouble getting the labor to install the equipment. Once those mills are installed and up and running, the mills are having trouble getting labor to operate those mills. They're having trouble getting labor to harvest trees. They're having trouble with the transportation networks to get the logs to the mills. So across the board, we're seeing what historically would be an 8 to 10 to 12 month ramp up time to get to full nameplate capacity. We're now seeing ramp up times closer to 3 years, so 36 months. So it's tremendously long ramp up times for these mills. And this likely isn't going to change going forward because mills are in rural areas with a rural workforce, and historically, that's been okay because mills were not that high tech. But a mill today uses less than half the number of workers. A new mill that's getting built today uses fewer than half the workers that a legacy mill uses in the South. So that means that for each of those workers, they need to be a lot more technically savvy. So you essentially need a computer science degree now to operate a sawmill. So there's just not a lot of those higher tech workers around the mills. And on top of that, those workers are competing for jobs in a lot of other sectors. You have Mercedes-Benz down there, you've got the oil fields down there, you've got other sectors that are, if we're talking about the US South, that are competing for those higher skilled workers. So we do expect to see a continued slow ramp up. In addition, we expect to see continued declines in ability for British Columbia to produce lumber. I'm kind of getting up against my time, so I'm going to move a little bit more quickly. I'm happy to answer this in questions, but I think you folks pretty much know about the mountain pine beetle, that loss of supply that's available there. In addition, we have a spruce bark beetle outbreak in British Columbia, which is going to affect that timber supply that's going to be available in the middle of this decade. We had massive wildfires in 1718, which is also going to cause, that's going to be another portion of the reason for this decline here. You have the set-asides for mountain caribou habitat. You have the forest transfer, tenure transfers to First Nations. You have the old growth deferrals. So all of these factors are going to cause the annual allowable cut to drop, which means there's just going to be less timber for British Columbia to be producing lumber. Something that you might not be quite as familiar with, but in the West Coast, we also see a decline in sustainable yields. This came from a number of factors, but one, the Labor Day fires of 2020. On top of that, there's the changes in the private forest accord and the forest practices code in Oregon. There's revisions to the availability of state resources in both Washington and Oregon. So when we look across all of this, there's been about a 10% decline in the sustainable yield in the US West Coast. So that's just less wood that's going to be available, less timber that's going to be available to turn into lumber in that region. So unlikely to see big increases in output. And in fact, based on declining sustainable yields, we're likely to see some declines. That does lead there is some opportunity in the east of Canada, but and especially if you look at this graph, you might say, oh, Quebec and Ontario looks like there's a lot of extra annual, there's a lot of AAC or allowable cut that's not being harvested. That red line's the AAC, the bars are our current harvest levels. But the reality is that a lot of that timber is pretty far north, so it's far from the markets, it's far from the mills. In addition, it's when it's far north, it's smaller woods, so you have a higher output of chips relative to lumber, so you're producing a lot of chips. It's also in mixed stands, so there's a lot of hardwoods. So you need to find alternative markets for those hardwoods that you're going to be harvesting and for the increased chip production. And right now, the traditional market of selling into the pulp markets, that with the decline in pulp production and the decline in newsprint demand, there's really not a lot. There's not a market for that, for those residuals and for the hardwoods that are also going to need to be harvested along with the softwood. So there's really practically it's not really practical to harvest a lot of that excess AAC, which leaves the U.S. South, and I think we all know what's going on there. There's plenty of fiber, so that's why we're seeing all the investment going to the U.S. South right now. So I'm going to turn quickly to exports, but I want to talk more about imports because I think that's of more interest to you folks. Exports are going to remain weak. Chinese consumption, China looks just, that's the main, you look historically back here, that's where a lot of our exports were going. That's off. That's unlikely to improve much in the near term because the Chinese economy is growing slowly. We do see some room for a bounce back here in 24, and that's as China loosens up its economy and reduces its COVID restrictions, allows for some bounce back. But the economy is going to grow a lot more slowly, and if we look at any of the forward-looking indicators, they're all pretty negative for the course of 2023 at least. And then there's a whole bunch of other factors involved as well. It's a shift towards more manufactured housing, so building off-site. They're not going to have as much of a need for scaffolding and concrete forming. In addition, there's a beetle issue in China as well, so there's going to be some more domestic harvesting. And then, so there's those factors lead to unlikely to see a massive rebound in exports. So that wood that was being exported is going to stay in the North American markets. On the import side, and this is something that I'm sure being in the East you are all familiar with, is European imports are surging. So this is just imports historical. I didn't put December on there, but that last bar is December. I break it out between Europe and other, and you can see the rapid increase in European shipments to North America. So European exports to North America, North American imports of European wood. That red line is not actually Europe's share of total offshore imports. What that is that's the percentage of Europe's exports to the U.S. It's what percentage of Canada's exports to the U.S. is Europe shipping right now. And the reason why I put that in there is because most folks obviously think of, oh, Canada is the main supply region for the U.S. But if you look at this, recently we've seen Europe become 40% plus of Canadian exports to the U.S. So European shipments to the U.S. are actually very, very high right now. So why is that, and do we expect that to continue going forward? Yes, for the short term, because European consumption is coming off. This graph here just shows European consumption, and that's come off sharply, and it's likely to remain weak in 24. Whatever recession we have, theirs is going to be worse because they're more reliant on. So the U.S. in particular is an energy exporter, where Europe is a major energy importer, and they're importing from Russia, which we know what's going on there. So they're not getting that energy, so that's driving them into a steeper recession than we'd see in North America. So their consumption is going to be weaker, which means that their excess supply is going to need to find a market to go to. North America is one of those. In addition, they have a spruce bark beetle outbreak. I'm happy to answer questions on this if you want during Q&A, but just in the interest of time, which suffice it to say that the outbreaks are worse when you have a dry, hot summer, and 22 was a very dry, hot year, one of the hottest and driest on record, and that meant more massive swarms of beetle, more generations, more spruce killed, more wood available for harvest. And we're seeing that into the North American markets. And just real quick, another issue is that freight is no longer as much of an issue as it was a year ago or 2 years ago. So with those freight constraints being eased, we would expect to continue to see wood coming into these markets. And then a final comment before I turn it over to questions. I'm kind of running out of time here, but and that is the pulp market. So pulp prices are actually are quite high. You guys operating in this market know that. Just pulpwood prices in the Northeast. This is coming about for a couple of reasons, but lower availability of pulpwood as the saw timber markets decline. There's not as much co-harvest, decreased production, leading to lower chip availability. So that's driving up demand for pulpwood at a time when that supply is declining. So that's helping to drive up prices. Increase in demand for home heating through hardwoods. But the biggest driver really of these price increases are higher fuel and logging and trucking constraints, capacity constraints, helping to drive these prices up. We do think we're probably near a peak, and that prices are unlikely to persist at this level, so they're likely to fall. We're starting to see hardwood chips being barged in from Nova Scotia, and we're starting to see pulp prices softening, and with the overall U.S. economy softening as well, we do think that these pulpwood prices are going to start to move down. So, Kyle, with that, I will just, I'll sort of end my presentation abruptly, put my contact information up here if you folks have any questions, and then I'll also, certainly happy to try to answer any questions that you might have.
So as a reminder, everybody, you can send in questions using the text chat question mark button there on the right side of your screen. I think, Paul, just to give everybody a minute or two here to send in questions, you covered a lot of ground in the last hour, to say the least. What are 3 quick takeaways that, as people hop off here, that they can take away?
Yeah. So the 3 takeaways that I would say is that 1, demand for our product. So the first one is going to be 3 things in and of itself, but demand for our product is going to decline, and with that, prices are going to be below where they were. So I guess that's really 1. So we are going to go into a downturn. We are in a downturn right now. Demand for our products is certainly going to decline, and with that, prices. Having said that, the second takeaway I would say is that prices are likely to remain elevated relative to history, and that's because the cost structure has changed dramatically from where it was a decade ago. And what do I mean by that? Well, we have a lot less fiber supply. We have a lot less timber available in British Columbia, which is the other main SPF producing region. We have less fiber supply available in the US West Coast. So those regions are going to see decreased ability to produce lumber, and that is going to hold prices up. Another thing that I would say is that Europe is sending a lot of wood into the North American markets, and that wood is likely to stay this year. It's really, if we have a cold, wet summer, then yes, we could see a decline in the availability of European wood. But the reality is Europe's economy is likely to be in a sharper downturn than ours. So to the extent that they were producing wood for the European markets, the European producers, that some of that wood's going to be going into the offshore market, especially any beetle-killed wood, because that blue-stained, lower quality spruce that's been killed isn't really consumed in Europe. They need to export it into North America, into the Middle East and North Africa, Australia, and China. So my 3 main points would be weaker consumption, certainly weaker prices, but those prices remaining elevated relative to history, and increased competition from Europe in the near term.
Okay. And then one of the questions that came in is, how is the reduced logging workforce going to impact the forest products industry?
Yeah, that's another factor that, it's unlikely. This isn't something that's just a Northeast thing. This is across North America. So the ultimate impact of that is prices are going to be higher than they would otherwise have been if we didn't have that reduced workforce. And we're seeing it, and the way this feeds through is we're seeing it in the US South right now, in that they can't get production is up, 1.5 billion board feet when they've added 5 billion board feet. So why is that? How is that possible? Because they can't get the they can't get the loggers to harvest the trees and deliver the logs. And so that the inability to increase production as quickly as capacity is increasing is limiting the amount of wood that's going into the amount of lumber into the market, and is preventing prices from going back to levels that we would have historically seen in a recession, right? Like, so if you go back to, say, the late 2000s, and we had lumber prices that were, I think on a weekly basis, I think we hit like 154. Whereas now, prices got to 325, and you saw a lot. You saw 2.1 billion board feet of closures when we saw prices drop to as low as 325. So it's just a much higher floor than we saw before because of that lack of that inability to produce.
Okay. And then is there any data or information available on how biochar can help these markets stabilize and keep up demand? And as it relates to wood chips and price per ton for wood chips or waste chips?
Yeah, so this is a little bit more specific to the last slide that I showed in the pulpwood and the so there's not data, there's not as nearly as much data on the biochar markets as there are on the lumber markets. So I guess the answer to the question, is there data? There's some, but it's really pretty sparse. So yes, markets like biochar, we need to develop these markets, markets like wood insulation. Obviously the pellet markets are important too, but these markets need to be developed because the Northeast is, so that North America is going to rely more on Northeast lumber production. And I don't just mean the Northeast US, but Northeast, Quebec, Ontario, the Maritimes. We're going to be more reliant on production out of the Northeast of North America than we were over the previous 2 decades. And that's going to occur because of that inability of British Columbia to produce. British Columbia is going to be producing 7 to 8 billion board feet of lumber compared to their previous peak of 15 plus billion board feet. So that's got to be made up somewhere. And yes, a lot of it's going to be made up with increased production out of the US South. But the reality is if you're talking about framing lumber, there's going to be a greater demand for SPF for framing lumber than there is southern yellow pine. It's just not as good of a species for that. So we do need, so it does play an important role in terms of having a market for the residuals.
Great. So I think with that, I think we're going to wrap up, Paul, for this afternoon. I really appreciate you taking the time to speak with us on the forest products industry. And then as a reminder for everybody else still on the line, a recording will be available at farmcrediteast.com/webinars, as well as our YouTube channel, as well as we'll have information for those seeking CEU credits will be available on our website as well. So with that, I wish everybody a great afternoon.
Thank you so much, Kyle. I appreciate it. And thanks to everybody who listened.